Hey folks, I hope you're doing fine. I'm Simo from Investment Research, and today I need to talk about what's happening with SoFi right now on November 7th, 2025. This stock just took a beating, trading around $26.16, and I'm seeing a lot of panic and confusion out there. So I'm cutting through the noise to give you the real analysis, looking at institutional data from Nasdaq, understanding why this drop happened, and most importantly, whether this presents a buying opportunity or a warning sign. This is my view as someone who studies this company like I'm on the inside, and by the end of this analysis, you'll know exactly what to do. Let's get into it. Alright, so let's talk about what's actually happening today. SoFi is trading around $27.16 as of November 7th, down from yesterday's close. Now, according to the latest data from Nasdaq and institutional sources, the stock has been consolidating after hitting an all-time high of $32.57 on October 29th. We've given back about 16% to 17% from that peak in just over a week. Volume is showing lower turnover, which tells me this isn't panic selling from retail investors. This is profit taking from institutional players who rode the rally from the Q3 earnings beat. Before I forgot this important metric on my notebook, the recent US government shutdown has had a ripple effect across global stock markets, creating a wave of uncertainty and volatility. As federal agencies halted operations and key economic data releases were delayed, investors found it harder to assess the true state of the US economy. This lack of reliable information led to a pullback in risk assets and a shift towards safer investments such as gold and bonds. Globally, markets reacted with caution since the US remains a major driver of international economic activity. The shutdown also disrupted business contracts and government spending, weighing on investor confidence. In particular, the fintech sector was affected by delays in regulatory approvals, IPO filings, and access to government data, all of which slowed operations and funding activity. Overall, while the broader market may recover once the government reopens, the shutdown has highlighted the vulnerability of both global markets and the fintech industry to policy gridlock in Washington. Alright, so let's talk about what's actually happening today. SoFi is trading around $27.16 as of November 7th, down from yesterday's close. Now, according to the latest data from Nasdaq and institutional sources, the stock has been consolidating after hitting an all-time high of $32.57 on October 29th. We've given back about 16% to 17% from that peak in just over a week. Volume is showing lower turnover, which tells me this isn't panic selling from retail investors. This is profit taking from institutional players who rode the rally from the Q3 earnings beat. Before I forgot, this important metric on my notebook. Here's what the technical picture looks like according to multiple institutional sources. A sell signal was issued from a pivot top point on Tuesday, October 28th, right after earnings, and the stock has fallen about 6% to 7% since then. The stock is testing key support levels at $28.14 and $26.14, and we're right in that zone now. According to Nasdaq data, if these support levels hold, we could see a bounce. If they break, the next support from accumulated volume sits at $25.62 to $25 range. Now, before everyone freaks out, let me give you the proper context. Year to date, SoFi is still up approximately 100% plus. Over the trailing 12 months, the stock has gained about 171% to 177%, depending on which source you check. The 5-day change shows we're down about 5.23%, but the month-over-month change is still a 12.53% rise. So yes, we're pulling back, but zoom out, and this stock has been one of the best performers in fintech all year. According to several analysts and forecasting models, this pullback is actually healthy consolidation after going parabolic. The IPO journey, where SoFi came from. Now, for those who are newer to SoFi or don't understand the full story, let me walk you through the IPO journey because understanding where this company came from makes today's price action make more sense. SoFi, which stands for Social Finance, was founded in 2011 by Mike Cagney, Ian Brady, James Finnegan, and Dan Macklin as a student loan refinancing company targeting millennials. The company went public on June 1st, 2021 through a SPAC merger with Social Capital Hedosophia Holdings Corp. V, ticker IPOE, backed by billionaire venture capital investor Chamath Palihapitiya, who was nicknamed the SPAC King. The SPAC deal valued SoFi at $8.65 billion and brought in approximately $2.4 billion in cash proceeds, including $1.2 billion from PIPE investors led by Palihapitiya himself, with participation from heavy hitters like BlackRock, Coatue Management, Baron Capital Group, and Altimeter. The SPAC raised $805 million from its balance sheet, plus additional funds from a prior T. Rowe Price investment. On its first trading day as SoFi on June 1st, 2021, the stock jumped 12% to $22.65 from the prior IPOE closing price of $20.15. The stock had actually hit an intraday all-time high of $25.78 back in February 2021 before the actual merger closed. Now here's what's critical to understand. SoFi was one of Chamath Palihapitiya's most successful SPAC deals. According to multiple analyses, while most of Chamath's 12 SPACs are down 80% or more from their IPO prices, Virgin Galactic collapsed, Clover Health imploded, and Opendoor's market cap dropped from $18 billion to under $1 billion, SoFi has actually performed relatively well. The company reported its first profitable quarter in 2024 and is arguably one of the best performing SPAC stocks alongside Hims and Hers. The stock is down less than 20% from its adjusted IPO price if you account for the initial pop. But when you consider the journey from the lows of $4.24 in December 2022 to today's $27, early believers who bought the dip are up over 500%. Okay, now let's talk about why I think this pullback is creating a buying opportunity, not a reason to panic. According to the latest institutional analysis and data I'm seeing, here's what's really happening. The model mix is shifting toward capital light revenue, which is exactly what institutional investors want to see. The risk reduction narrative aligns with SoFi's multi-year push beyond balance sheet lending into fee and platform revenue. That direction was front and center in last week's Q3 results, and this is why smart money analysts are applauding a lower risk posture even as the stock pulls back. The street is still split even after a blowout quarter. Fresh analyst reports this morning highlight the consensus hold rating with a wide spread of targets ranging from $20 on the low end to $38 on the high end from firms like Needham and Mizuho. According to institutional analysis, divergent views typically mean news flow, and execution can move the stock swiftly in either direction. There's price versus target tension, with shares hovering around the mid-20s. Several rundowns note the average near-term target sits around where the stock trades or slightly below, while some analysts and outlets see more headroom. Let me break down the Q3 2025 results that drove the initial rally, because understanding these numbers is critical. SoFi reported record net revenue of approximately $962 million, adjusted net revenue of $950 million, net income of $139 million, and adjusted EPS of $0.11 versus estimates of $0.08. That's a 37.5% beat on earnings. The company added a record 905,000 new members in Q3, bringing total membership to 12.6 million, up 35% year over year. They added 1.4 million new products, accelerating product growth to 36% year over year for a total of 18.6 million products. The cross-buy rate hit 40%, the highest since 2022, which shows the one-stop shop strategy is working brilliantly. Fee-based revenue hit a record $409 million, up 50% year over year, now representing 43% of total adjusted net revenue. This transition away from capital-intensive lending toward capital-light fee-based revenue is why operating margins improved to 15.4% from 9.2% a year ago. Management raised full-year guidance significantly, with adjusted net revenue now expected at $3,540 million versus $3,375 million previously, representing 36% growth. Adjusted EPS guidance was raised to 37 cents from 31 cents, a 19% increase. Now, let me tell you what institutional investors are actually doing based on the data I'm seeing from Nasdaq and other reputable sources. Following the Q3 earnings beat, multiple major firms raised price targets. Needham raised to $36 from $29 with a buy rating. Mizuho raised to $38 from $31, also a buy. Citi raised to $37 from $28. Goldman Sachs raised to $27 from $24, but maintained a hold. UBS raised to $27.50 from $20.50. JP Morgan raised to $28 from $26, but stayed neutral. Even the cautious firms are raising targets, which tells you the fundamental story is undeniable. According to the consensus from 22 analysts covering the stock, only 6 recommend buying shares, with the rest at hold or sell. The Wall Street consensus one-year price target has risen to around $26, which is actually below the current stock price, meaning the street expects limited upside in the near term. However, 24/7 Wall Street, a reputable independent research firm, is more bullish with a $29.41 target by year end, and they project SoFi could reach $55.30 per share by the end of the decade, with 10% year-over-year revenue growth and a conservative 3.5 times price-to-sales valuation. According to one top investor quoted in recent coverage, SoFi's story is just the beginning. The thesis is that SoFi's loan platform business is exploding, nearly quadrupling volume from the second quarter to the third quarter. The home loan business is growing 93% year over year and could accelerate dramatically if mortgage rates fall as expected in 2026. The company is also positioned to benefit from potential privatization of federal student loans under policy changes, where SoFi is one of the few companies with technical capabilities to service private student loans at scale. The trading opportunity right now. So here's my view on the trading opportunity. Based on multiple forecasting models and technical analysis from institutional sources, some models suggest SoFi could trade between $35.60 and $35.70, $41.41 over the next 3 months, with a 90% probability, representing 29% to 52% upside from current levels around $27. Other more conservative forecasts show a range between $20.96 and $30.97 for the remainder of 2025. The key support levels to watch are $28.14, which we're testing right now, $27.14 just below, and then $25.62 if those break. From a technical standpoint, several trading analysts on platforms like TradingView are noting that the stock looks strong on charts, with a successful breakout and retest of triangle patterns around the IPO price of $28.26. The 4-hour chart shows a continuation gap up that happened after earnings, and the stock has overtaken key pivot levels. Multiple traders are projecting upside targets of $35 and eventually $40 if momentum continues. The stock lies in the middle of a wide and strong rising trend in the short term, and further rise within the trend is signaled according to technical indicators. However, there are also negative signals. A sell signal was issued from a pivot top, and volume fell during recent trading days despite gaining prices earlier, which causes divergence between volume and price and may be an early warning. On the downside, there's natural risk involved when a stock is testing support levels, since if this is broken, the stock may fall to the next support level. According to institutional volume analysis, there's accumulated volume support at $28.14 and $27.14, which is where we are now. Alright, so here's my honest take as someone analyzing SoFi. Like, I'm part of the internal research team. This company is executing exceptionally well. The Q3 results were outstanding. Guidance was raised significantly. The business model is transitioning to capital-light, fee-based revenue, which is higher quality. Credit quality is strong with declining charge-offs, and management has a clear growth vision with new initiatives in crypto, blockchain, and AI launching soon. The member growth is explosive. Adding 905,000 members in a single quarter is insane. The 40% cross-buy rate shows the one-stop shop strategy is working. Brand awareness is only 9.1%, which means there's a massive runway for growth as more Americans learn about SoFi. The company achieved a Rule of 40 score of 67%, which is elite territory for fintech and software companies. This measures revenue growth plus EBITDA margin, and anything above 40% is considered excellent. However, the stock ran too fast. Up over 170% in a year and hitting all-time highs, some consolidation was inevitable and healthy. The valuation at current levels, around $27, implies a market cap of about $35 to $36 billion on roughly $3.5 billion in annual revenue, which puts the price-to-sales ratio at 10 to 11 times. For a company growing at 36% to 38% with expanding profitability, that's not outrageously expensive, but it's also not cheap. Traditional banks trade at 2 to 3 times sales. High-growth unprofitable fintechs trade at 5 to 8 times. SoFi is in a unique category, high growth and profitable, but the easy money has been made. So here's my rating. For existing shareholders, I'm saying hold. If you bought this stock below $20, you're sitting on massive gains. Consider trimming 10% to 20% to lock in profits and reduce risk, but hold the core position because the fundamental story is intact. For new investors or those looking to add, I'm saying this pullback to the $27 range is a potential entry point, but I'd prefer to wait for $25 to $26 for better risk reward. If we break below $27 convincingly, wait for the $25 level. That would represent about 23% off the all-time high and would provide a nice margin of safety. The key catalysts I'm watching include whether these support levels at $28 and $27 hold, the launch of crypto trading by year end, and whether it drives engagement, Q4 earnings in late January or early February 2026 to confirm the raised guidance trajectory, any announcements regarding the federal student loan privatization opportunity, and credit quality metrics in Q4 to ensure charge-offs remain low even if the economy weakens. One more thing, according to recent coverage, model mix keeps shifting toward capital light, which is exactly what you want to see. The risk reduction narrative helps frame why institutional commentary is applauding a lower risk posture even as retail investors panic about the price drop. Compared to the performance of most SPACs, especially Chamath's other deals which are down 80%, SoFi is arguably the most successful. Share price is down less than 20% from adjusted IPO levels, and the company reported its first profitable quarter in 2024. Alright folks, that's my complete analysis on SoFi Technologies as of November 7th, 2025. This is a high quality fintech company executing at a very high level. The recent pullback from all-time highs is healthy consolidation, not a fundamental problem. For long-term investors with conviction in the fintech disruption story and SoFi's ability to become a dominant digital bank, this pullback could be an opportunity. But for traders and new money, wait for better technical confirmation that support is holding or for a deeper pullback to $25. As always, do your own research, understand your risk tolerance, and never invest more than you can afford to lose. Thanks for watching, and I'll see you in the next analysis.